I'm very excited to speak to Darius Dale, who is the CEO and founder of 42 Macro and just has a very dynamic data-driven model. Very excited. Welcome, Darius.
No, thank you, Elliot. Appreciate you, man. Thanks for having me.
No, absolutely. It's a very polarized market, right? You have the perma gold bulls saying that we're going to have inflation forever. We're going to go into hyperinflation in the next few months or years. You have the tech people. You got your Kathy Wood saying that, oh, no, it's going to be straight deflationary forever, right? You have robotics, demographics, all these big trends. But then we have your model, right? Which is based on the actual data, like just so many different data points. It's as close as I think we can get to figuring out what's going to happen. So that's why I want to ask you first. What is your model saying right now?
Yeah, can I take a step back and sort of explain how we think about the world here at 42 Macro?
That'd be great.
We view the world through a regime segmentation process that's based on the trending rate of change of growth and the trending rate of change of inflation. And so at any given time, the economy can be in one of four states when you marry those two factors together. One we call Goldilocks. That's where growth is accelerating and inflation is decelerating. You move clockwise across that chart. You look at inflation and growth accelerating simultaneously. That's really the only sort of regime where you would expect to see bond yields rising on a real and nominal basis, or at least, over the last 30, 40 years of the back test. When you go down to further clockwise, you have growth trending lower and inflation trending higher. That's stagflation. That's what we call inflation. That tends to, be, obviously negative for equity and credit markets, in so much that deflation, which is a scenario where growth and inflation are decelerating simultaneously, that's also tends to be negative for equity and credit markets. But you also obviously tend to see outsized excess returns in the treasury bond market and things like gold and the dollar. So at any given time, we're trying to identify where is the economy in this regime segmentation process, and more importantly, what are the asset markets starting to signal at the margins about where the next state of that economy is in. Or, so when you think about sort of the policy response, obviously we have fiscal policy to deal with, to analyze as investors and or interpret. We also have monetary policy to analyze and interpret as investors. And so the reality is you tend to get a lot of sort of wiggles that, if you just let the economy live, it would just obviously go in this sort of natural early cycle, mid cycle, late cycle process, right? Every once in a while, obviously, in response to being in deflation in particular, the Federal Reserve, the fiscal policy, the fiscal authorities will come out and do something that sort of pushes you into a reflation or pushes you into a Goldilocks state. But then obviously that tends to sort of be something we have to pay back on the backside. So at any given time, we're trying to identify, okay, where are we headed? Where are we now? Where are we headed? And what things do we need to buy and sell in the portfolio construction process to actually anticipate and further prepare for those transitions?
Yeah, exactly. And I mean, it makes a lot of sense, right? Because in those scenarios you're talking about, right, in the grid, right, you have the inflation, deflation, Goldilocks. In that scenario, there's always preferred asset classes that do well. And that's kind of what you want to be in once you confirm that you're in that type of environment, right?
Yeah.
And that is the $1 million question, right? So what is the model saying?
Yeah, that's a great question. So I'm sharing my screen here, just give you a sense of what I mean by that regime segmentation process. So as again, on the x-axis, we show the 3-month delta on headline CPI. On the y-axis, we show the 3-month delta of the OECD composite leading index time series. That's what we use to measure growth, giving us a monthly read and the ability to spot inflection points in the economy, sort of intra-quarter that you tend not to get with lagging GDP data. So in terms of what the model is currently signaling, this is the broader matrix, showing all the different countries who maintain this modeling process for. The U.S. is the top row. And so as we can see, for the month of July, it's very likely we're still in reflation from a bottom-up macro regime perspective in the month of July. That means growth and inflation are accelerating on a trending basis. That's also likely to be the case in August. But as you can see, once you get into September and really into all the way through the first quarter of next year, and this is the same for a lot of economies, obviously, you're going to leave a lot of that dry land, that reflationary dry land, and you're going to tiptoe back into deflation. And so again, when I say deflation, we're not talking about outright negative year-over-year price changes. We're just talking about both growth and inflation are trending lower on a delta on a rate of change basis. So that's something to keep in mind. So right now, it's really what we're trying to figure out is, okay, what does the market think? Is the market ready to start to price that in? because at any given time between 3 months and coincident, the market is going to start to pivot to pricing in those deltas in the economy. And so right now we run what we call our global macro risk matrix, which allows us to nowcast the market regime probability, i.e., which of these grids is the market pricing in. And so as you can see from this chart here, we'd obviously been in reflation, or we emerged from the depths of the crisis. Looking here, this is May of last year. We emerged from the depths of the crisis in Goldilocks. But then eventually the market really started to aggressively price in reflation, really starting in early November of last year and really carrying all the way through, late May, early June of this year. In early June of this year, the market sort of had a transition to Goldilocks because it understood that this dynamic going from, over a year of reflation to, this emergent, these emergent Ds for deflation is something that could perpetuate Goldilocks, at least a transitory Goldilocks, that we're sort of experience here in the second half of June and all throughout the month of July. But as you see this blue line here, that nowcasting process, and again, how we get to those nowcasts, we're looking at 42 different market indicators, obviously the most widely followed financial market indicators across the world, and we're scoring them through the lens of what we call our volatility adjusted momentum signal. And so, that's a mouthful, but again, if you're bullish or bearish in this table, you're contributing scores to each of those grid regimes based on your historical behavior in the grid regimes. And so when you look at what's happening in that table, those 42 indicators, they're now starting to nowcast a tied possibility of both Goldilocks and deflation. And this is new. This is new as of July 27th. And so this is something, if we really start to see that push towards deflation, i.e. it's something that, really overtakes Goldilocks as the modal outcome, it will further necessitate a more defensive posturing in investor portfolios. As you can see, deflation, that's where your long, large cap growth, dividends, quality, mid cap growth, low beta, your short high beta, your short cyclicals, short value. It's pretty common sense what you want to do when growth and inflation are slowing, particularly in the fixed income market. Obviously, you're long the long bond, you're long IG credit, your short cyclicality, your short credit risk. So it's pretty, it makes a lot of sense intuitively. And the reason it makes a lot of sense intuitively is because these findings, these learnings here on slide 15 are born out of, a quarter century, 30, 40, 50 years of financial market history that are informing these back tests through the lens of that regime segmentation process.
Yeah, so you've back tested these asset allocations in these environments and it works, right? So that's why it's just super exciting, because it's almost like a crystal ball in terms of like, if the data's saying this, you buy this, which is awesome. So, and I remember watching, I was actually watching a podcast of you 2 months ago, and you were calling for an increase in deflation in 2 months. And here we are, the blue line you showed just ticked up, which is pretty much exactly what you're expecting. Here's the question though, is it too early to take advantage of? I mean, has the market front run that already? Are there still an opportunity to take advantage of a coming deflation?
Yeah, that's a great question. So I would argue, yes, the market is front running to some degree. And by definition, the blue line going up on this page implies the market is pricing in at the margin of deflation, right? Like, so in terms of the signals that are contributing to deflation in the global macro risk matrix, the vast majority of the rate exposures in here are already bearish. We have the 10-year German Bund's been bearish since early July. The 10-year gilt yield, UK gilt yield's been bearish since early July. 10-year JGB yield's been bearish since early June. The 10-year TIPS yield has been bearish since early June. So a lot of stuff has already moved in that direction, and now we're just waiting on incremental confirmation, from the currency market, from the commodity market, from the equity market, and you're starting to see little snippets of that. But by and large, a lot of the currency and commodity exposures in this model are in a neutral VAM state, i.e. they're not contributing to either score from any of the regimes. And so, you could either break back positively for a lot of those, or you could break negatively for a lot of those over the coming weeks. That would obviously, sort of further tilt the markets in the model into deflation and really open up, it'll catalyze a lot of probable downside in the ranges of a lot of asset exposures, a lot of securities that didn't firmly exist as a function of those securities either being neutral or bullish. So to me, I think we're in a very interesting state in the markets, in the asset markets, in the economy, because again, this is this chart here, the chart on the right specifically shows the total number of signals that are contributing to each regime. And as you can see, when you look at the black line, we have, there's only 44 total signals, contributing to each regime. You go back to August of last year, you had over 90. That 44 numbers in the 13th percentile reading for this time series, which obviously goes back to the start of 1998, which is the chart on the left. And so it's telling you that the asset markets are extremely confused about that they lack conviction in either regime in a way that would suggest you need to be, aggressively in size and, in 1, 2, 3, or 4 of these, particular setups. And so that to me is saying we're at a very critical juncture in asset markets that we need to, one, observe and orient ourselves according to how it changes over the next couple of weeks.
So I guess the question would be like how to take advantage of that. Because like you're saying, the equity market hasn't confirmed deflation yet, but that's almost like maybe it's an opportunity if a lot of other signals are saying it's going to be deflation.
Well, the equity market always gets the message last, right? Like, so you
right.
Our model pivoted to deflation on February 9th of 2020, right? S&P is still making all-time highs up until February 19th of 2020. So, clearly the equity market tends to get the signal last. And that makes a lot of sense if you think about what the U.S. equity market has become. It's become a bastion of mega cap safety, bastion of mega cap non-cyclicality, like, secular growth and all these things that will continue to do well, in a declining inflation environment, decelerating growth and inflation environment. So that's partially why you see the S&P 500 and NASDAQ, tend to peak after a lot of stuff has already moved in macro, but that doesn't mean it's immune to a drawdown.
I know you have this, you kind of like stagger into positions over time, right? Like you'll have a forecast and like 3 months out, you'll put a little bit in and then you'll just slowly get bigger and bigger into it. So how have you kind of positioned for a deflationary move?
Yeah, absolutely. So we, in conjunction with that signal, we've already moved there. So let me talk to you about that process. So when we believe there's a phase transition in the economy that ultimately asset markets will have to respond to and price in on a trending basis, as early as 3 months out, we'll start to buy that stuff. We'll start to, tiptoe into the exposures that agree with one of these columns based on our expectation of how the economy is likely to evolve. And so as early as May of this year, we started buying treasury bonds, even though we were in reflation, where you actually lose money in treasury bonds mostly. And part of the reason for that was because, we think we're 3 months away from a potential transition to deflation in terms of that big table that we highlighted earlier. That transition ultimately got extended and delayed up until September, but at least in May we thought, it might be actually come, as early as July. So that was something that we started to allocate towards, and then incrementally you're adding the things along the way, every interval, every month along that process. You're saying, let me get even more fixed income exposure. Let me get even more, US dollar type exposure, gold type exposure. But eventually, the problem with deflation is that you're going to run out of stuff to buy. There's a lot less stuff to buy when the economy is slowing, when growth and inflation are slowing, because you tend to see a lot more sort of volatility develop in cyclical assets that, there's not a lot of safety. Because, the Fed owns 30% of the treasury bond market. Like, you're running out of stuff to buy when you want to actually put on full deflation. But, I think of it's not just about the asset allocation pivots. A lot of the, hedge fund type investors who use our research services, you think about this through the lens of their style factor pivots, right? You're going to go from small cap value and high beta cyclicals to low beta defensives and quality and dividends. That's a big pivot, right? Like, that's a massive pivot considering, one, how liquid, equity markets are, but two, that's the kind of pivot that if you get right, it can make your year, in so much that if you didn't proactively prepare for it before it happened, it could actually ruin your year and get you, actually cost you your job at a lot of places. Thinking about a place like Citadel or Millennium, where you can't suffer drawdowns more in excess of 3%. So the process is dangerous for a lot of investors who use it in a lot of different ways.
Yeah, exactly. And I mean, just thinking about like the way the markets work, they're so sensitive now, because you could argue a debt bubble built on money printing, right? So So if there's any sort of fear, right, any deflation like you're talking about, we're talking major volatility. Isn't that kind of how the markets are? They're very sensitive now. Mm-hmm. So de-risking.
This whole game needs perpetual, sort of easy money. Like, there's just too much debt out there, both on the private sector and also on the public sector balance sheets, to really allow for a real strong, real interest rate environment. right? These guys constantly have to keep the easy money game going. And on real interest rates themselves, like we just actually hit a new all-time low in the 10-year TIPS yield. To me, that's like shocking that no one is talking about that. To me, it's like it's a pretty clear harbinger that the growth outlook is obviously coming into question. And this is something that, one is already sort of priced into our models. But by definition, this is our US grid model. So we run the same process again for every country in the world, at least the ones that the OECD maintains the composite leading index time series for. And what we're coming out of obviously is a little over a year of trending acceleration, and that's giving way to trending deceleration by at least we expect that to commence in September. When you look at kind of what the growth outlook looks on the time series format, obviously we're peaking and you're going to start to roll over. We're not going to crash. There's still a lot of reopening momentum. There's still a lot of cash on consumer balance sheets. We still have potential for getting incremental pockets of the population vaccinated. So it's very unlikely that we decelerate by a meaningful degree. But I'm actually kind of concerned about that statement that I just made, because again, we're now seeing new all-time lows in the 10-year TIPS deal. Now, let's not forget the Fed now owns 25% of the TIPS market. So clearly they're an outsized influence on wherever that chart is priced. However, I don't believe that it's lost all of its signaling power. And so to me, when I think about that, this deceleration in growth and this deceleration in inflation, but really focusing on the growth aspect of it, when you look at U.S. growth expectations for this year, the blue line, 6.6%, the red line is next year, 4.2%. Those numbers are astronomically high and well above trend. And so when you talk about a 10-year TIPS yield that's hitting new all-time lows here in July, late July, in the context of consensus having, well above trend growth, basically 7% growth for this year, 4% growth for next year, that to me is a real clear indication that something's afoot. Something is afoot with these expectations. And the problem with these expectations, if you marry them with our expectation for the economy to decelerate persistently, is that you might wind up in a scenario throughout the back half of this year and well into next year where economic growth and earnings are persistently disappointing. Right? We came out of a period where economic growth and earnings were persistently, surprising to the upside as a function of reopening, as a function of not being able to accurately model with the impact of vaccines, the impact of fiscal policy. But now we actually have all that mostly in the rearview mirror. And so I think it's very easy. We see a cascading sequence of negative economic disappointment throughout the back half of this year that really calls into question, again, these really elevated growth expectations. So that to me is what the 10-year TIPS yield is signaling right now.
Oh, absolutely. That is huge. I mean, I always, if consensus is super long, super bullish one direction, which is in this case is growth, and you're saying the macro regime is starting to shift, usually it's the consensus that gets kind of hurt in that environment because they get caught off guard, right?
Yeah, totally.
So, wow, that is absolutely brilliant. Just thinking about the perfect storm that could be brewing in the back half of the year, even commodities.
Well, I would say, just on that point you just made in terms of catching everyone off guard, I would argue they were caught off guard in June, and they're no longer truly off guard, at least not your traditional hedge fund buy-side consensus. One of the things I look at, or two of the things I look at, is sort of the relationship between the 30-day implied volatility relative to the local volatility regime. And then I also look at sector and style factor dispersion to identify which of these regimes is investor consensus being forced into by the mothership, the Citadel, the guys who run the risk management, those types of things. Or are they actually just explicitly allocating to based on their own fundamental view? And since for the last 6 weeks, it's been a clear, at least the chart on the right has been a clear signal to me, at least, or to people who sort of look at the world through this regime segmentation process lens. It's been that they've been moving defensive. They've been selling cyclicals, selling value, selling high beta, and increasingly rotating into defensives, mega cap, FANG type safety, size, those types of things. So I would argue investor consensus was caught off guard by the June FOMC meeting, but ever since that moment, they've been actually trying to right size their positioning to get to position themselves for the cycle. So I would suspect that if we have a true real deflation move, that hedge funds aren't going to get truly torn up by that. But I think your slower moving asset allocators, your long only type investors, and potentially some of your retail type investors who've obviously speculated in some of the most speculative things we've ever seen in our careers are kind of holding the bag on that stuff.
Exactly. So that's brilliant. I love that you have the insight into kind of what like the quote unquote smart money is doing, right? So they've positioned, but I was kind of referring to the hordes, the retail, the masses who, like you just said, are not expecting this at all. So super, super interesting and insightful, very helpful. And so this is obviously really, really helpful for time the intermediate term, the next few months. Do you have a long-term view, like let's say 3 years out approach, an allocation strategy
Yeah,
that you're?
absolutely. So yeah, so I spend most of my time, as you might imagine, consulting investors on cyclical risks and how they are likely to impact, sector and style factor leadership in the equity market, how they're likely to impact, sector leadership in the fixed income market, which currencies are likely to outperform, what basket of commodities would tend to do best in the cyclical environment. But all that stuff's based on the rate of change, growth, and inflation cycle, and how that's historically impacted asset markets. But I do have longer term beliefs in terms of, okay, if we've been in a 20-year period where we've been oscillating between, sort of Goldilocks and deflation from a bottom-up macro regime perspective, could we be entering a 10 to 15, 20-year period where we're no longer doing that from a frequency perspective, but we're actually oscillating between reflation and inflation because there's more inflation in the system? That to me is, I think, something that a lot of investors are debating. A lot of people, when they talk about, okay, I'm an inflationista or I'm a secular inflationist, they talk about it as if it's going to be this linear straight line. That's not the case. It's very unlikely to be a linear straight line. One, based on base effects. But two, based on reopening dynamics actually dissipating in the back half of the year and early part of next year. You're not going to perpetually be reopening the economy. And so let me spend it before I actually get into the cyclical view or secular view. Let me spend a second talking about inflation in terms of what I mean by that nonlinear path higher for inflation. And so clearly we're well above trend inflation. This is a chart of headline CPI. One's a 30-year chart, one's a 5-year chart. The chart on the right, obviously focusing on that. We obviously we run two different models and we sort of combine those two models into a median projection, and that's the purple line in both of these charts. And clearly our median projection has inflation coming down, by over 100 basis points, well over 100 basis points over the next 12-month time horizon. So that's good from a disinflation perspective. That's good for allocating to Goldilocks and or deflation, which is the current that's the current debate in the market right now. However, when you look at the chart on the left, it's very likely that we bottom in the middle of next year. Sometime in July, August of next year, we start to reaccelerate in reported inflation terms. And that is really important to know, to call out, because it means we're going to be reaccelerating from very elevated levels of inflation. Like that second wave of inflation, which is exactly what we saw coming out of the deflation of the GFC. We peaked in 2010, decelerated, and we started to reaccelerate it again once we went back up against the easy base effects on a 2-year and 3-year basis. And that's going to happen at some point in the back half of next year. And so the reality is we're going to start, the stationary mean of this time series was 1.5% throughout the post-crisis era. And it may very well be the case that as a function of fiscal policy dynamics and a function of monetary policy dynamics, and then as a function of some of the wage pressures that we're seeing emerge in the labor market, that the stationary mean of inflation is now somewhere close to 2.5%, 3%, as opposed to 1.5%. That's an enormous deal. And again, I don't think we have to all price it in today. I think a lot of it got priced in at the early May highs and cyclicals and then the early June highs of most commodity charts. But that doesn't mean those charts are going to go back to where they were, in April, May of last year in 2020. They're going to make a much higher low and new highs, once the market really starts to sniff out everything I just said about the stationary mean of inflation transposing itself higher. So I don't know when that's going to occur, but I suspect it's not, at least not going to be for several quarters, because again, a lot of that positioning has to get wrung out of the market.
Wow, just my mind is being blown right now, seriously. So what that chart is saying is that so we're going to have some deflation in the back half of the year. It's going to catch the big retail crowd probably off guard potentially, right? Everyone's pricing in inflation, long commodities. They're going to get hurt then, but long term, you're saying there's this sustained level of high prices, increasing inflation that does have serious, significant impacts. So what does that world look like to you, just of higher inflation? Is there fear? Is it like the 1970s where everyone goes huge into silver and gold? Or
let's unpack why I believe that, right? So look, I think it's important to sort of show your work and why you have these longer term views. So just from the perspective of our data driven process, there's 4 real key structural risks that we think investors have to sort of price in at any given time. One, there's demographics, which we sort of look at through the lens of the 5-year forward old age dependency ratio, We look at through the lens of the working age population ratio, what that 5-year forward CAGR is, to give you a sense of, okay, what's the growth potential in the economy? Sort of where is the labor market going to be from a participation rate perspective, employment to population perspective? So those things obviously have a meaningful impact on growth and inflation. The second structural risk to look at is balance of payments risk. And so this is one of the key drivers of inflation longer term, if you think about the ultimate impact on the dollar once we get out of the crisis. So obviously, we're looking at that through the lens of the current account balance as a percent of GDP. We're also looking at it through the lens of the sovereign fiscal balance as a percent of GDP. And obviously, the US dot being down there to the left implies there's a lot of sort of financing pressure on the US government that either needs to be met by higher short-term interest rates so the Fed can entice foreign capital allocators, the foreign official sector, reserve managers back into the treasury market, or they need to just buy more bonds in the long end of the curve, to keep interest rates from going up and actually keep the government well supplied, well financed. So that's a dilemma that, we can talk about this in a second, but that's a dilemma that markets need to figure out. And I would argue the Fed itself needs to figure out. But again, we could talk, we'll table that for now. 46 shows the leverage. Leverage is one of those 4 key secular forces. And so, we look at leverage through the lens of, the private non-financial sector credit to GDP ratio. And we're also looking at it through the lens of the private non-financial sector debt service ratio. So, when you're an economy, when you're up here to the right, it means you've grown credit a lot, and you've had a decent amount of tightening of financial tightening as a function of either raising interest rates or declining incomes or both. And when you're down here, that's when you're the lows of the economic cycle. You've had credit contract, you've had financial easing, and that's when you give yourself an opportunity to go here. So as you notice, most of the economies in the world are over to the right, which means they've grown credit pretty meaningfully throughout the downturn as a policy response to the downturn. So that's something that we think could slow growth in this this next 12-month time horizon before we really start to reaccelerate in growth and inflation. And then lastly, slide 47, politics. So when you layer on our views on politics and the balance of payments and how we think about politics is through the lens of the Gini coefficient and the headline unemployment rate. The first thing I think everyone should notice about this chart is just the location of the US dot. Like, we're here surrounded by, for lack of a better term, a bunch of emerging market economies,
right?
Hanging out with our developed market friends over here. This is where you would expect the world's lone superpower, the biggest superpower, to be. No, but we're hanging out between China, Mexico, and Russia, and Chile.
Right.
To me, this is why, in my opinion, the location of that dot and the location of the US dot on this chart, the balance of payments chart, tells me that there's a tremendous amount of latent pressure on the dollar as a function of the likely fiscal monetary policy response to the locations of those dots. So clearly the fiscal response to the location of this dot, which I would argue is perpetuating the zeitgeist that catalyzed a lot of people to take to the streets last summer. It catalyzed people to take to the White House or to Congress in the winter. Like, populism is now increasingly becoming bipartisan. And the reason it's increasingly becoming bipartisan is because there's a legitimate zeitgeist associated with the location of this dot. America's becoming a very unequal, unemployed society. Like, there's 9.5 million people unemployed, probably another, 4, 5, 6 million people who are underemployed and hate their lives and hate their jobs and their inability to generate a living wage. And so that's a lot of people, right? Like, that you're talking about a significant chunk of the labor force. So, it's a big enough chunk of the labor force to be a meaningful swing voting participant, which is why populism is becoming increasingly bipartisan. This is why we're talking about 1.5 to 1 to 1.5 to $2 trillion deficits in peacetime, as opposed to $500 billion deficits. Right? That's why the stationary mean of the deficit time series has transposed itself higher, because it's bipartisan. And so, to answer your question, like, you think about the secular pressure on the dollar associated with the fiscal response to the location of this dot and the likely monetary response to the location of this dot in terms of who has to pay for all that stuff. That, to me, gets to a scenario where you can really see the dollar decline meaningfully over the long term. This is the red line, is the chart of the trade weighted dollar here. And obviously, just given where it is in terms of its long-term time series, it can go down a lot from here. It could and should go down a lot from here if I'm half right on the fiscal monetary policy evolution that we're seeing in the economy towards an MT. I don't think we're going to adopt an MT, but I certainly think we're going towards that. At every interval we have in terms of a growth slowdown or a market event.
Wow. So that is essentially what kind of the gold bugs have been predicting for a long time, right? I mean, they might get hurt in the next disinflationary wave, which happens at the back half of the year, but 2022, is that kind of the time frame, like later 2022, when just the dollar gets serious pressure?
Yeah, I would argue on the other side of, whenever the market is done pricing in, and I would argue we potentially are at the very earliest precipice of it pricing in the back half deflation or deflation macro regime. That could persist for, several months, a couple of quarters at least. And at some point it'll, the market will stop pricing that in and really start to look forward into, okay, what's the policy response to what's happening right now? Because again, the market's really smart in terms of, it takes the escalator up, because that's kind of the speed that economic developments occur, earnings growth occurs, GDP is added to the economy, but it takes the window down because that's usually the speed all those things reverse, and then eventually asset markets tend to bottom before the economy does, and the reason for that is obviously the policy response. So there will be a policy response if we see a hiccup in the markets, particularly in risk markets, as a function of everything I just said that's likely to occur in the back half of the year in terms of decelerating growth and inflation, economic disappointment. You got a fiscal policy vacuum where you don't really have any incremental fiscal stimulus, and obviously you have a potential for a Fed taper some point in Q3 or Q4. That is obviously negative for markets. So you could have this sort of 6 to 9 month window where it's just not going to be great to be a risk taker. It's going to be great to be long things like treasuries and gold and the U.S. dollar. But from wherever that process concludes, and again, I'd be remiss to pretend like I have an idea of when it's likely to conclude. But whenever, that's why we built that global macro risk matrix, to give us a real live data-driven nowcast on, okay, it's now concluded. It's safe to get back in the water again. So at some point that model will signal it's safe to get back in the water again. And when it's safe to get back in the water again, you're not going to be able to tie down a copper chart or an ag chart, or, you're not going to be able to hold up the dollar chart, because again, you're going to be thinking about a world that's in a better place from a pandemic perspective. Europe will be in a better place. Emerging markets will be in a better place. There'll be a lot more places for U.S. investors and capital allocators, and more importantly, global capital allocators to flow assets to that are not dollar denominated securities or assets. And that to me is where you could really start to see a big move lower in the dollar.
Okay, got it. And so it seems like we're in uncharted waters because of the deficits you're talking about, the sustained kind of higher deficits and inflation. So what is there any sort of period that this compares to in terms of thinking about where to allocate money, or is this just completely like exponentially crazy? Like,
no, I mean, it's certainly akin to the 1960s. So we had a lot of interventionist monetary and fiscal policy in the 40s. I don't know if it's a perfect example, because again, you're coming out of the war. There's a lot of stuff you need to build, and you had this sort of real big push into you did not yet have the big push into the labor market from female labor force participation. I think it's probably more akin to the 60s, where you kind of had that. You kind of had a lot of the same monetary and fiscal dynamics that really ultimately led to a much higher level, a much higher sort of trend growth rate of wage growth, a much higher trend, sort of growth rate of inflation. And that to me is like kind of where you potentially walking into. I'm sure you're familiar with Neil Howe, my former colleague at Hedgeye, Peter Churchin, who wrote Ages of Discord. They have sort of similar frameworks on, how economies and institutions evolve as a response to a lot of the political sort of consternation in the economy. And, both of those frameworks would argue that, we still have some time before we ultimately get to those crescendos of where we see, the maximum sort of, entropy in terms of the fiscal response, the monetary response, the breaking down of institutions. And that to me is like where we're likely headed. And to me, this is why I think, if you want to talk about what the world will look like from a domestic policy perspective later on down the line, I could easily see the Fed and Treasury becoming a merged entity that's designed to sort of micromanage every wiggle in the economy, every wiggle in the asset markets. Now they're kind of already doing that, right? Like they don't have an implicit mandate to do that. But if you think, if things get bad enough on the inflation front, they get bad enough on the real growth front, or more importantly, they get bad enough on the inequality front. And you get, and one thing we haven't even talked about yet, what's the likelihood that all those incremental unemployed people that got unemployed in this cycle get their jobs back? Like if you're an employer and you're realizing elevated productivity and high, earnings growth, why in the hell are you incentivized to hire back all those people? We could just see some real structural hysteresis develop in the labor market. That's a function of the pandemic, that actually, further puts pressure on policymakers to do more to respond to that. So to me, this is like, I see it coming in waves where they're constantly, as a function of the midterm election process, obviously the general election process, and then again as a function of these economic wiggles, they're going to be constantly marching towards this very interventionist policy, and that to me is very 1960s heading into the 1970s.
Absolutely. And so when does because like they're clearly sacrificing the dollar in order to, micromanage and prop up, everything they possibly can. So when does the confidence in their ability to do that end? And like, I'm trying to think of what could they do to respond to this type of crazy environment that we're talking about.
Yeah, I don't live in the realm of could, because I don't think that's how you get paid as an investor. But no, as a person, as a human being who's just generally interested in these developments, I think there's a lot of stuff there's a lot of levers they can pull. Now, I'm of the view, just based on my, learnings and readings about, historical societies and ancient civilizations, there's no way you can print your way into prosperity. Right, like Neil Ferguson wrote The Ascent of Money, I think in 2010 or whatever, and like it's a case by case study of all these different civilizations that tried to devalue their currencies and perpetuate prosperity, and every single time it ends in heartbreak, because that's kind of you can't cheat the system, right? You're constrained by your productive capacity in the economy and your ability to grow your labor force. Like that's pretty much it. And so all you're really doing is pulling forward incremental demand from the future. And so understanding that, we know what they're likely to do. Every politician that's been faced with this since ancient Mesopotamia has sort of done the same thing, which is promise poor people stuff and try to tax the rich people or devalue the currency to pay for it. We've been doing the same stuff for thousands of years. It's shocking to me that we haven't all figured this out yet. Like in retrospect, like the smartest thing anybody could have done was in 2009 say, yeah, they're going to just try to print their way out of this and just buy stocks. In retrospect, like every once in a while, like, or sort of along the way, we all kind of figured it out. But like, I would argue the average investor didn't really figure it out until 2017. And even the smartest people in finance didn't really figure that out until 2013. Right. Like it took us a while to figure out that we were all frogs in a pot being boiled alive. And eventually, we're all going to understand that. And you're not going to be able to tie down asset markets. But between now and then, that's how you obviously get these sort of wiggles in the economic cycle and the market cycle.
Gotcha. Yeah. And I'm just thinking a lot of investors might be thinking, oh, we're going to turn into Zimbabwe, but it's probably going to be more like a British Empire type of deal where people are still, doing okay.
There have to be alternatives if you really want to sell the dollar, right? Like there's no such thing as I'm selling the dollar. Well, if you sold the dollar, you bought another currency, right? You're now long another exposure. Right. It's all relative to something else. So could it be Bitcoin? Could it be, cryptocurrencies? Could it be gold? It could be a lot of things. It's obviously for a period of time there, it was NFTs and stuff like that, right? So like, people are smart. People with capital have capital for a reason, either because their parents were smart and gave them a bunch of capital on the way out, or they earned a lot of capital, right? Like you tend to be the intelligent faction of society. So people will find out what to do with the money when they realize they're frogs in a pot being boiled alive. But the reality is, until you get those signals that you're frog in a pot being boiled alive, you don't really know. You don't really have the confidence to do that. But along the way, it's obviously all real developing in real time.
Yeah, I mean, gosh, this was incredibly helpful. Like, man, I can't say it enough. Like, you seriously blew my mind. I hope that everyone follows you. Just keep track of all this. So where can people go to learn more?
Yeah, so I appreciate that, Ellie. Thank you. So I'm founder and CEO of 42 Macro. Again, spoke to a lot of the regime segmentation that we do to help investors manage sort of what I would consider to be medium-term cyclical risks. On average is about 2.5 pivots from risk on to risk off every year. And that's sort of what our regime segmentation process is designed to help investors figure out. Is it a disinflationary risk on or disinflationary risk off? Is it an inflationary risk on or an inflationary risk off? And timing those pivots, a couple times a year, 2 to 3 times a year, is really valuable in terms of not losing a lot of money, drawing down in assets that go from one state where they're good to another state where they're bad. Like that, just identifying those pain points is something we do for investors at 42 Macro. And so if people want to check us out, obviously 42macro.com. My Twitter is at 42macro ddale, DDALE. So I'd love interacting with our subscribers and what we call Team 42, which is our global network of thoughtful investors who who really believe in a data-driven macro risk management approach. So come check us out. We appreciate you guys, and thank you, Elliot.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.